Okay, so if ethical investing worked the way most people think it does, the planet would already be in a much better place than it is right now, because over the last decade, trillions of pounds have flowed into ethical, sustainable, and responsible funds, and yet emissions are still rising, inequality hasn't reversed, and most ethical portfolios still look suspiciously like the global stock market with just a few industries quietly removed. So something doesn't add up, and the uncomfortable answer is this. ESG investing was never designed to measure morality. It was designed to measure risk. Everything else, the language, the branding, the idea that you're doing good with your money, that came after, which means a lot of people aren't actually investing more ethically, they're just feeling more ethical while buying broadly the same assets. So in this video, I want to unpack why I think ethical investing doesn't work the way it's sold, and what you can actually do if you want your money to reflect your values without falling for the marketing around it. So an ESG score essentially asks, is this company likely to face regulation, lawsuits, or governance scandals that could hurt future profits? Sensible question if you're making billions on behalf of pension holders, but not the same as asking whether a company is making the world better. And once you understand that, well, a lot of weird stuff suddenly makes sense, like how in 2022 S&P Global kicked Tesla out of its ESG index, but kept ExxonMobil in. Not because Exxon is greener, but because it's better at paperwork and risk management. Tesla was busy building EVs, while Exxon was filling in the right forms. And from the system's point of view, the oil major looked safer. But from a moral point of view, that conclusion feels borderline insane. Once you accept that ESG is about risk rather than virtue, the next thing you notice is visual. Ethical funds all look weirdly familiar. You open the holdings and it's Apple, Microsoft, Alphabet, Visa, some healthcare, maybe a few consumer brands with good PR, and suddenly you're staring at what looks like a global index fund that's had a polite disagreement with oil and tobacco. This isn't because fund managers are lazy or non-smokers, it's because once you exclude fossil fuels, arms, gambling, tobacco, and a handful of other industries, you remove huge chunks of the economy, and what's left is heavily tilted towards tech and services. This is discussed pretty openly in The Ethical Investor, which points out that people expect ethical funds to feel radically different, but structurally they often can't be because public markets are still public markets, which creates a mismatch that no glossy brochure or website ever really addresses. People think they're buying impact when they're mostly buying omission. And omission isn't obviously nothing, but it's also not the same as change. And I'm not saying these funds are bad, I'm just saying that calling them ethical is like calling Diet Coke a health plan. Sure, it's less harmful than full fat, but let's not pretend it's doing the heavy lifting. So what's the alternative? Well, you could build your own. Not an ESG fund or something someone else has approved, just a portfolio that reflects your own decisions made consciously with your own exclusions. Yes, it takes more effort than clicking a filter, but that's kind of the point, right? The effort is what makes it meaningful. And that's exactly what I did using Trading 212's PI system. Rather than buying someone else's interpretation of my values, Trading 212 let me build something specific, and I'll show you exactly how easy it was. Okay, so this is what I built, including the companies that I feel align with my values, and I actually set this up in less than an hour. But before I even opened the Trading 212 app, I did 4 things. First, I wrote down my exclusions: fossil fuels, arms, tobacco, data mining, and gambling. Second, I used Baillie Gifford's Positive Change Fund as a reference point. They're one of the UK's biggest active fund managers, and this particular fund is built specifically around companies working on social and environmental problems. They publish their full holdings every month, which I'll link in the description. That gave me around 35 to 40 companies already screened for genuine impact. And I'm not copying their portfolio, I'm just using their research as a starting point. Third, I asked Claude. And while I'm aware of the irony of using a power-hungry AI to build a green portfolio, I needed it to summarize what each company actually does and flag anything that conflicted with my exclusions. And fourth, I added a few of my own. Companies I already knew, sectors I care about, things I've read about recently. You can do the same. You could also use other impact funds who publish their holdings, or you could simply ask an AI to suggest listed companies working in areas that matter to you and go from there. And once I had my list, I opened Trading 212 and built my pie. I went with equal weighting across all the companies because, let's be honest, I really don't know which one will perform better. So for me, that's the simplest approach. And this is what it looks like. I also have a Trading 212 affiliate link in the description box. It's labeled as a sponsored link. If you are planning to sign up anyway, using it costs you nothing and does help support myself and the channel. Also, if you're feeling extra generous, please do consider hitting subscribe. That'd be really nice. Thank you. But I have to be honest with you about something. Everything I've just shown you, the exclusions, the pie, the process, it's all still public market investing, which means when you buy those shares, you're almost certainly buying them from another investor, not the company itself. You're not directly funding anything. You're just making a deliberate, conscious choice about what you're willing to own. I think that definitely matters, but it's not the same as impact. If you want to get closer to actually funding something like a wind farm, then you need to look outside the stock market entirely. In the UK, Triodos Bank runs a crowdfunding platform where you can actually lend directly to organizations doing exactly that. Wind farms, community hydro schemes, charity bonds, rewilding projects. The range is really broad. Minimums start at £50, and most investments qualify as innovative finance ISAs, so they're shielded from tax. But of course, there are risks. 2 of their past investments went into liquidation, which may sound alarming until you remember that buying shares in a company carries the same risk. The difference with Triodos is that you're locked in for a full term, typically 5 to 10 years. So this isn't money you might need back in a hurry. But for money you're genuinely comfortable committing in the long term, I think it's probably the closest thing to actually funding something rather than just owning a slice of it. But there is an uncomfortable truth to investing this way, whether through crowdfunding or a values-aligned portfolio. It's probably going to cost you. Because ethical portfolios can underperform over long periods of time, especially once you start to exclude entire industries and reduce diversification. But at the same time, every investment approach, ethical or not, comes with trade-offs. A standard global index fund might give you broader diversification and slightly better returns, but it also means owning companies you may fundamentally disagree with. Fossil fuels, weapons manufacturers, gambling firms, whatever your line happens to be. And for some, not crossing that line is more important than making slightly better returns. And not because they think it will save the world, but because they'd rather their money reflected their values. In my opinion, ethical investing isn't broken because people are naive. It's broken because the industry found a way to sell you moral comfort without requiring any moral clarity. Real ethical investing asks you to make trade-offs. You have to accept that public markets are a blunt instrument and sit with the slightly uncomfortable truth that your ISA isn't going to rewrite the rules of capitalism. But that's fine. You don't need it to. You just need to know what you actually own and why you own it, and what it does and doesn't do. Because at the bare minimum, you should know when you're drinking Diet Coke and when you're making a change.